Let's talk about February 2nd, 2026. A truly fascinating day. The market opened right on a knife's edge, staring down two major threats, a potentially hawkish new Fed nominee and a sudden, sharp collapse in commodities. But by the closing bell, all that fear had just vanished. It was replaced by a rally built on one single thing: pure, undeniable economic strength. So today, we're not just going to tell you what happened, we're going to show you exactly why it happened. We're going to follow the trail of one crucial piece of data as it tore through every corner of the market, from bonds to stocks to currencies.
All right, so here's how we're going to break this all down. First, we'll set the scene, that really fearful pre-market environment. Then, we'll pinpoint the exact catalyst that flipped the entire script. After that, we'll trace its powerful economic ripple effects, see which sectors won and which lost in the rotation that followed, and then we'll wrap it all up by translating this analysis into some clear, actionable investor playbooks.
So let's start at the market open. You have to understand, the mood was deeply negative. The S&P 500, the Nasdaq, the Dow, they were all trading in the red. And this wasn't just some mild profit-taking. No, this was a genuine risk-off posture, and it was being driven by two very distinct and very powerful headwinds that had traders on high alert.
Let's break down these two fears, because they're critical. First, you had what people were calling the Wash shock. The nomination of Kevin Wash to be the next Fed chair, well, it sent a real shiver through the markets. He is known for his view that the Fed needs to accelerate its balance sheet reduction, what we call quantitative tightening. Now, this is a deeply hawkish stance because it's not just about interest rates, it's about actively removing liquidity, pulling cash out of the financial system. The fear was that he'd push this mechanical tightening no matter what the economic data said. Then, at the same time, you had this violent plunge in gold and silver. This sparked fears of a classic leverage-driven contagion. See, when speculative positions like that get wiped out so quickly, it triggers margin calls, and that forces funds to sell other, more liquid assets, like their tech stocks, just to raise cash. The market was basically bracing for waves of forced selling.
And yet, despite that pretty formidable wall of worry, the market staged a dramatic reversal. The S&P 500, it finished the day up 0.54%, the Nasdaq climbed 0.56%, and the Dow actually led the way, closing up over 1%. Now, this wasn't just some sentiment-driven bounce. No, this pivot was triggered by a single piece of hard, fundamental economic data that completely overpowered that fear narrative. So the critical question becomes, right, what force could possibly be strong enough to counteract that deeply negative sentiment? What could convince institutions to look past the risk of a hawkish Fed, to look past a commodity liquidation event, and instead start deploying capital aggressively back into stocks? The answer came down to this one number released at 10 a.m. Eastern Time, 52.6. And look, this wasn't just another data point in a busy morning. This was the inflection point. This number re-anchored the entire market narrative for the day, providing a fundamental truth about the state of the U.S. economy that was simply too powerful for anyone to ignore. So what is 52.6? It's the ISM Manufacturing PMI. And it didn't just beat the consensus expectation of 48.5, it absolutely shattered it. Now, for some context, the PMI is what we call a diffusion index. A reading above 50 means the manufacturing sector is expanding. Below 50, it's contracting. So after 12 straight months stuck in contractionary territory, this leap to 52.6 wasn't just a beat, it was a regime change. It just crushed that lingering recession narrative that had been capping market enthusiasm. And if you dig a little deeper, the forward-looking new order subindex came in at a blistering 57.1. That signals a huge pipeline of future demand, and it's a powerful leading indicator for corporate earnings. In a matter of seconds, the market went from fearing a policy mistake to celebrating undeniable economic reacceleration. Now, a single data point like this, it doesn't just affect stocks in a vacuum. It sends these powerful waves across every major asset class. An economic surprise of this magnitude forces an immediate system-wide repricing of growth and inflation expectations. And that repricing then cascades directly into the bond market, into the currency market, and even into commodities. We can actually trace this causal chain with a lot of precision. That blowout ISM print, it immediately forced analysts to scrap their soft landing or recession models. The new base case became a no landing scenario. That's the idea that the economy isn't landing at all, it's actually reaccelerating. Now, a stronger growth outlook means two things for the bond market. First, the Fed has absolutely zero reason to cut rates anytime soon. Second, robust growth can create inflationary pressures. Both of those factors push bond yields higher. And that combination, a stronger domestic economy and higher relative interest rates, makes U.S. assets more attractive to foreign capital.
And what does that do? It causes the US dollar to strengthen.
And we can see the concrete impact right here in the numbers. The 10-year Treasury yield, which is a benchmark for global borrowing costs, it jumped 4 basis points to 4.28%. Bond traders were immediately pricing out the odds of any imminent Fed rate cuts. Then, in the currency markets, the US dollar index surged over 0.6%. That is a significant intraday move, reflecting that capital flowing towards a stronger US economy. Now, what's really interesting is that WTI crude oil acted as a crucial counterweight. It fell nearly 5%. This was driven by a totally separate news item, reports of diplomatic progress between the US and Iran. This basically removed the war premium from oil prices, providing a timely disinflationary impulse that helped soothe the market's inflation fears, even as that ISM data was coming in red hot.
So this dramatic shift in the macroeconomic picture, it triggered an equally dramatic rotation within the equity market itself. When the story changes this fast, capital doesn't just flow into the market uniformly. It aggressively rotates within the market, selling the old narrative and buying the new one. And wow, this divergence between the day's best and worst performing sectors, it tells the whole story. At the very top, you have consumer staples, a classically defensive sector, leading the entire S&P 500 with a 1.6% gain. And at the very bottom, you have the energy sector, crushed by 2.0%. This isn't random noise. This is a perfect logical reflection of the day's macro inputs. Drilling down into the logic here, the picture gets even clearer. The strength in consumer staples, the XLP ETF, it might seem a little counterintuitive on a strong economic day. But it makes perfect sense. While investors were cheering the economic strength, that wash shock created this lingering policy uncertainty. In that kind of environment, investors seek out companies with stable, non-cyclical cash flows. Think companies like Walmart and Costco that sell necessities no matter what the economic cycle is doing. On the other side, the weakness in the energy sector ETF, XLE, was a pure, direct trade on the falling price of oil. The easing geopolitical tensions directly hit the earnings outlook for oil producers, and that triggered immediate selling. Commentary from market heavyweights also played a huge role in calming those initial policy fears. This quote from the legendary investor Stanley Druckenmiller was particularly impactful. When a voice like his speaks, the market listens. By framing Kevin Wash not as some rigid ideologue, but as a data-dependent pragmatist, Druckenmiller basically gave the market permission to believe that the new Fed wouldn't just tighten policy into oblivion if the data didn't warrant it. This helps shift the focus away from the man and back to the economic numbers themselves. So what does this all mean for investors? How do you take all of these complex signals and turn them into a clear portfolio strategy? Well, the day's price action really lays out a very clear framework for two distinct approaches to this new no-landing reality. So two data-driven strategies clearly emerge from this. The aggressive playbook basically argues that this strong economy validates the massive capital investment cycle we're seeing in AI and semiconductors. This thesis would use ETFs like SMH for chips and IGV for software, betting that strong manufacturing and enterprise demand will drive earnings higher. The primary risk here, of course, is volatility from a hawkish Fed. The stable playbook is a bit more nuanced. It positions for steady growth through industrials, say with the XLI ETF, which is a direct beneficiary of a manufacturing resurgence. But at the same time, it maintains a defensive posture against rate uncertainty by holding consumer staples, XLP, whose stable dividends become more attractive if rates stay higher for longer. The action in individual stocks gives us some really crucial micro-level evidence for these macro themes. Palantir's massive 8% jump after hours on blowout earnings, that confirmed the insatiable corporate demand for AI software, supporting that aggressive thesis. Western Digital's surge on an analyst upgrade for memory chip pricing, that reinforces the idea of a cyclical upturn in semiconductors. But Disney's 7% plunge on weak guidance serves as a really critical counterpoint. It shows that even in a strong economy, the consumer is becoming more selective, a dynamic that could act as a natural cap on inflation. This sharp reversal was perfectly captured in the market's sentiment gauges. The VIX index, which measures the market's expectation of 30-day volatility, it collapsed by over 6% down to 16.34. A falling VIX means traders are pricing in a lower probability of large sudden market swings. The fear of some tail risk event, which was sparked by the morning shocks, was completely priced out as the certainty of that ISM data took hold. So ultimately, the entire narrative of the day was just this powerful and decisive pivot. The session began with the market paralyzed by policy risk and speculation. It ended with the market confidently pricing in robust economic strength. That ISM data was the key. It was the undeniable piece of evidence that allowed investors to look through the noise of Washington appointments and commodity fluctuations and to refocus on the single most important driver of corporate earnings, a resilient, expanding U.S. economy.
And this brings us to the crucial, forward-looking question. The market has emphatically celebrated the death of the recession narrative. But a no-landing scenario where growth actually reaccelerates brings its own set of challenges. Does this undeniable economic strength risk reigniting inflation, which could force the Federal Reserve's hand later in the year? It's very possible the market has just traded one risk for another. And this new debate over inflation versus growth is what's going to define the next chapter for all of us as investors.